Welcome back to Investing Talk Podcast. Today, we're tackling a question quite a few of you are asking about Oscar Health. Simply put, is now a good time to buy shares in this company?
It's definitely one that's been getting a lot of attention.
Yeah, absolutely. We've gathered, well, a pretty extensive stack of source material, everything from SEC filings, analyst reports, technical charts, you name it. Our mission today is to really unpack all of this, give you the most important nuggets of insight, and help you, understand what's truly going on with Oscar Health.
Sort of cut through the noise.
Exactly. Think of us as guides through this sometimes complex financial landscape. Before we really dig in, though, if you're enjoying our analysis, please do hit that subscribe button. Like this episode, maybe leave a comment below.
And definitely let us know if there's a specific company you'd like us to look into next time.
Yeah, we love getting those suggestions in the comments. All right, let's kick things off with Oscar Health itself. For anyone who might not be fully familiar, what exactly does Oscar Health do, and what does its financial picture look like right now?
Sure. So Oscar Health operates as a tech-enabled managed care provider. They're primarily focused on individual and family plans under the Affordable Care Act, the ACA. What makes them different, really, is their unique digital-first member experience. They're trying to use tech to make things easier.
Okay, a tech angle in health insurance.
Got it. Exactly. And looking at their fundamentals, the company shows, pretty strong top-line growth. In 2024, their full-year revenue hit $7.13 billion.
Wow, okay.
Yeah, that's about a 40% jump from $5.1 billion in 2023.
40%, that's significant.
It is. And this growth seems linked to expanding those individual and family plans and also revenue from their technology platform.
Okay, let's unpack this. Strong revenue growth sounds good, obviously. But what about the bottom line? I mean, are they making money? Is this growth translating?
Right, that's the million-dollar question, isn't it? What's fascinating here is the trend. While they posted a net loss of $72.7 million in 2024...
Still a loss, then?
Still a loss, yes. But, and this is key, it's a significant improvement from the $608 million loss they had in 2023.
Okay, whoa. That's a big swing.
Huge swing. It really reflects better cost management and solid premium growth. Their adjusted EBITDA margin for FY 2024 also improved significantly. It went to negative 0.8% from negative 5.1% in 2023.
So closer to break even, but not quite there.
Not quite there, but moving in the right direction. And their medical loss ratio, basically how much they spend on claims versus premiums, also got better, down to 80.9% in 2024 from 82.7% the year before.
So narrowing losses is positive, definitely a good sign, but still not consistently profitable.
What about their overall financial health? Like, do they have enough cash?
Yeah.
Liquidity?
That's a crucial point for a company still in growth mode. Financially, they actually appear pretty robust in terms of liquidity. As of June 30th, 2025, Oscar Health had about $2.23 billion in cash and short-term investments.
Okay.
That's comparable to where they were at the end of 2024, and their total debt is relatively low, around $335 million. But maybe the most important thing, the real highlight perhaps, is they generated positive operating cash flow, $288.8 million in the first half of 2025.
Okay, that is significant. It really is. It's a huge turnaround from the cash outflows they had in previous years. Signals they might be starting to stand on their own 2 feet operationally. Their current ratio is also decent, about 1.3x, suggesting strong short-term liquidity.
That shift to positive operating cash flow is definitely a key improvement, something to watch. So, summing up this part, strong revenue growth, improving cash flow, even if that consistent net profit isn't quite there yet, a company in transition.
Exactly.
Now, Oscar Health clearly has this unique approach with its tech-enabled model. How does this position them against the giants in the healthcare space, big incumbents?
Yeah, they definitely differentiate with that digital-first experience and their plus Oscar technology platform. It's meant to be smoother, more user-friendly. But, they compete with some very large, very established players. Think United Health, Centene, Molina. These are massive organizations.
Right. Those are household names in insurance. So have they been making any moves to, bolster their competitive edge?
To fight back? Yes, absolutely. If we connect this to the bigger picture, Oscar Health has been strategically quite active. Recently, back in May 2025, they made a few acquisitions.
Oh, interesting. Like what?
Companies like INSX Cloud, IHG Specialty Benefits, and healthinsurance.org. These seem aimed at broadening their distribution and member acquisition capabilities, basically getting their plans in front of more people.
So trying to grab more market share?
Precisely. especially in that individual market. Their market share in the ACA exchange is growing, but you always have to remember this is an intensely competitive and, importantly, highly regulated sector.
Right. Regulation is huge in healthcare.
Absolutely, and that inherently limits pricing power for everyone involved.
Okay. So they're leveraging technology and making smart acquisitions to grow and carve out their niche, but it's happening in a really tough market.
That sums it up well.
All right, let's shift gears a bit. For those who look at charts, what has Oscar Health's stock price actually been doing recently? Here's where it gets really interesting sometimes.
Well, over the last 3 months, Oscar Health has traded mostly in a range. Call it between $15.20 and $18.86. We've seen pretty strong technical support down around that $15 or $15.50 level. The price bounced off there repeatedly in July and August of 2025.
Okay, so a floor around 15 bucks.
Seems like it, yeah. Buyers step in there.
And on the flip side, where is it meeting resistance? Where's the ceiling?
That overhead resistance looks pretty clear between $18 in many 50s and $19.20. The stock has tested that level twice since April 2025, but hasn't managed to, break through it convincingly.
Step below 19, basically.
For now, yeah.
Huh?
And it's worth noting, volatility remains pretty elevated. It has a beta of around 1.5 compared to the S&P 500.
Meaning it moves more dramatically than the overall market.
Exactly. About 50% more, on average. So bigger swings up and down.
What do the other indicators tell us? Like, what about its current trend? Momentum.
The price is trading slightly above its 50-day and 200-day simple moving averages. Those are at $16.80 and $15.75 respectively. So that generally indicates a modest upward trend.
Okay, that's positive.
It is. However, the relative strength index, the RSI, is near 65. That's approaching what some traders consider overbought territory. Not extreme yet, but getting up there.
Could signal a pullback soon.
Potentially, yeah. Or at least a pause. The MACD, another momentum indicator, is positive, but the momentum itself seems to have slowed down recently. So overall, you could say a mild uptrend since April 2025, but that momentum is definitely weakening as it approaches that $19 resistance level we talked about.
Got it. So range-bound action with weakening upward momentum near resistance.
That's a fair summary of the recent technical picture.
Okay. Beyond the numbers and charts, what's been making news for Oscar Health? And how are analysts and investors feeling about all this? What's the sentiment out there?
Well, back in July 2025, Oscar Health reported its second quarter results. They showed, solid 29% revenue growth, and they reaffirmed their 2025 guidance.
That was good so far.
Right, but the continued lack of profitability, the EPS was negative 0.69 cents. That led to some bearish sentiment right after the announcement.
So the market focused on the loss.
Pretty much. And management even revised its outlook slightly, citing potentially higher medical loss ratios and increased claims costs as headwinds, things that could make hitting profit targets harder.
So it's a real mixed bag then. Growth is there, but profitability concerns linger. What about analyst ratings? What are they saying?
Yeah, it's definitely mixed. As of September 2025, the consensus from Bloomberg analysts rates Oscar Health as a hold. That's based on 6 analysts covering it. But it's not unanimous. There are actually 2 buy ratings and 3 sell ratings mixed in there, too.
Okay, so no strong consensus either way.
Not really. And notably, some big names, Barclays, UBS, Wells Fargo, they actually downgraded Oscar Health recently. They cited regulatory concerns and uncertainty around those medical loss ratios and pricing discipline.
Downgrades from major banks.
Yeah.
That usually gets noticed.
It does. Reflects that caution in the market.
What about insider activity? Sometimes that can give us a clue, right? Are insiders buying or selling?
That's a great point, and it's actually quite interesting here. While there were multiple Form 4 filings in September showing share dispositions by insiders,
Selling shares.
well, yes, but the reason is crucial. These were specifically RSU-related shares, restricted stock units being withheld purely for tax purposes.
Okay, so not them actively choosing to sell on the open market.
Exactly. It's an automatic thing to cover taxes when RSUs vest. It does not indicate negative insider sentiment. And all those insiders still hold substantial equity stakes afterward.
That's a really important distinction. So no red flags from insider selling, really.
Correct. And on the institutional side, Invesco actually increased its holdings, which signals some confidence from a large investor.
Okay. And didn't we see a big jump in the stock back in August? What was that about?
Yes, absolutely. Oscar Health stock surged almost 25% in August. That happened after news came out about a potential House Republican bill to extend the Affordable Care Act subsidies.
Right, the ACA subsidies. That's huge for their business model.
Crucial. Since they're heavily exchange-driven, Anything that makes those plans more affordable via subsidies is a direct potential benefit to their revenue and membership. That news was a big regulatory catalyst.
So putting it all together, what does this mean? We've got analysts being cautious, maybe leaning hold or sell, but institutional buying, no real negative insider selling, and a big regulatory catalyst causing a major stock surge. Lots of moving pieces.
A very complex picture, definitely. Lots for investors to weigh.
Looking forward then, what events or developments should listeners really keep an eye on for Oscar Health? What are the upcoming catalysts, positive or negative?
Okay, short term, there are two big ones coming up. First, their Q3 2025 earnings report. That's expected in early November.
What will people be looking for there?
Continued revenue growth, obviously, but really any tangible progress towards profitability, especially after that guidance revision, and updates on managing those medical costs. Second big thing is the ACA open enrollment period, which kicks off in November. News on membership numbers, how many new policies they sell, that's a direct indicator of future revenue.
Right, enrollment season is key for them.
Absolutely.
Yeah.
And then there's that potential decision on extending the ACA subsidies, likely expected sometime in early December. That remains a huge regulatory question mark.
And longer term, beyond the next few months.
Longer term, a key catalyst would be the successful integration and expansion of those recent acquisitions we mentioned, INSX Cloud, IHC, healthinsurance.org. If they can leverage those effectively, that could mean higher member growth and more platform revenue in 2026, 2027. And of course, the biggest long-term driver would be achieving sustainable net profitability and consistent positive adjusted EBITDA. That's the ultimate goal.
Makes sense. But with every opportunity, there are risks. What should investors be aware of? What are the potential downsides here?
Yeah, this raises an important question. What are the challenges they face? Stock-specific risks include the fact, as we've said, that the company isn't consistently profitable yet. They remain really reliant on premium growth and tight cost control.
Which isn't guaranteed.
Exactly. There's also execution risk. Can they successfully integrate those acquisitions and make them pay off? Regulatory risk is always a factor in healthcare. Changes to the ACA or state rules could significantly impact their core business. And there's concentration risk, too, being heavily dependent on just a few states for revenue.
Okay, those are company-specific. What about broader risks?
Well, broader market and sector risks include that intense competition from the big incumbents we talked about. Healthcare policy risk at the congressional level is always lurking. And general market volatility growth stocks like Oscar, with that higher beta, are sensitive to interest rate changes and overall market sentiment shifts.
We've also heard whispers of rumors, right? Anything speculative but potentially significant worth noting.
Yeah, there's always market chatter. Some speculation includes potential strategic partnerships, maybe with major telehealth providers or pharmacy benefit managers, to boost their platform. Given their improving cash flow but lagging profitability, there are also some whispers about private equity maybe sniffing around, looking for undervalued health tech assets.
Interesting. Takeover potential.
Pure speculation,
Yeah.
but it's out there. Other rumors mention finalizing a large reinsurance contract, which could help manage risk, or even potential leadership changes focused on accelerating profitability.
Okay, so just rumors, but they highlight possible future directions or events.
Exactly. Worth keeping in the back of your mind, but treat them as speculation for now.
All right, we've covered a lot. Oscar Health's improving, but not yet perfect. Fundamentals, the technical picture, the competitive landscape, recent news, catalysts, risks, even rumors. So let's get to the core question. Is now a good time to buy Oscar Health? What's our overall summary based on this analysis?
Okay, pulling it all together, the sources seem to give Oscar Health an overall rating of 5 out of 10.
Right in the middle. Why?
The rationale is basically that balancing act we've been discussing. Oscar Health is showing improving fundamentals, strong membership growth, narrowing losses, and, crucially, that positive operating cash flow as of mid-2025. That's good. However, sustained net profitability remains unproven. That's the big hurdle they still need to clear. And the industry context, high competition, ongoing regulatory risk, those are significant, persistent headwinds.
So a 5-10 suggests, maybe not a screaming buy, but not a definite sell either. It sounds like this isn't a short-term trading opportunity.
Precisely. It seems best suited for a long-term investment horizon. We're talking 3 years or more. It's really for investors seeking exposure to that potential digital transformation in managed care, people who believe in the tech story and are willing to wait for profitability to hopefully materialize.
So patience is required.
Definitely. It doesn't look like a strong candidate for short-term trading. You've got that overhead resistance on the chart. The valuation is still a bit high relative to current profits. And there aren't really strong near-term technical catalysts pointing upwards right now. And importantly, as we discussed, those insider transactions don't show pessimism or voluntary selling, which is a positive for anyone thinking long-term. The key insight maybe isn't just the numbers, but how their tech model seems to be translating growth into better operational efficiency. That's potentially a critical turning point.
So for Oscar Health, it seems we're looking at a company with a significant growth potential and improving financial past, definitely,
Yep.
but one that still absolutely needs to prove its long-term profitability in what is clearly a challenging regulated market.
Yeah.
It's a marathon, not a sprint.
Exactly. That journey toward consistent profitability is really the key narrative to watch.
Well, thank you for joining us for this exploration of Oscar Health. We really hope this analysis has given you a clearer picture and helps you in your own decision-making process. And here's a final thought for you to ponder as we wrap up. Given Oscar Health's blend of, well, robust revenue growth, but those persistent profitability challenges in a highly regulated sector, how much weight should investors really place on a company's trajectory where it seems to be going versus its current state where it actually is right now? It's a classic growth investing dilemma.
Definitely something to think about. And just a reminder, of course, this discussion is for informational purposes only and should not be considered investment advice. Always do your own research.
Thanks again for tuning in, and we look forward to our next analysis with you.